I don't care about the death benefit. Have you ever felt like that when you're looking for a whole life insurance policy and maximum cash value? That's your goal. You're attracted to what you can do with these policies as far as growing the money, safe, liquid, tax-free area to position money, and also the loan feature, right? We can borrow from the cash value, and when we take a loan, it's optional to pay it back, but the beauty is I still earn dividends and interest on my entire cash value, as if I never touched it in the first place. A lot of things I can do with the cash value life insurance policy. But often we feel like, okay, I'm interested in the cash value. I don't really care about the death benefit. Can I just minimize it? Because I want the absolute minimum insurance expenses. Well, a death benefit is required because it is a life insurance policy. But the importance here, if you say, hey, I don't care about the death benefit at all, perhaps I'm self-insured or whatever it comes out to, that's enough. That'll take care of my family perhaps. Where the death benefit is important is if we focus on the cash value, what are the benefits again? The safety, the liquidity, but the third one, tax-free. If we do everything properly with a life insurance policy, I can use that cash value completely tax-free. However, I can mess it up and have to deal with tax consequences on the cash value. There's a couple things that can occur. One item that is most common is what is called a MEC, Modified Endowment Contract. Any life insurance policy can become classified as a modified endowment contract. If it does, the cash value still grows tax deferred. However, when I access that cash value in respect to the gains, I have to deal with ordinary income tax on the gains and a potential 10% penalty tax if I'm under the age of 59 and a half. So the reason I mention that is every policy has what is called a MEC limit. And it's just like what it sounds like. It's a limit that determines how much money I can pay into a policy per year and still have that policy classified as life insurance by the IRS, not a pure taxable investment. So where am I going with this? Because this video has to do with the death benefit and not caring about it. Well, that MEC limit has a direct relationship to an individual's age and total death benefit on a life insurance policy. So, for example, we've got a chart up on the screen. If I am a 50-year-old male and I have a $1 million death benefit, that obtains me a $50,000 MEC limit. If I am a 50-year-old male and I want a $2 million death benefit, or I say, I don't care about the death benefit, I want the ability to put in $100,000 per year, well, in order to obtain a $100,000 MEC limit, I would need a $2 million death benefit. So as we push that death benefit up or down, all of a sudden you see that MEC limit moves up or down. And you see a couple other examples on the chart as well as a 30, 40, 50, and 60-year-old individual there, male and female. The MEC limit will vary based on the total death benefit. This is something that's fairly easy to run. However, again, the importance is if we don't care about the death benefit, we can still minimize the insurance expenses, we can minimize the underlying premium, we can use term insurance riders to keep our costs at a minimum, but the death benefit will have a play at the end of the day in determining my ultimate MEC limit. So, if my goal is maximum cash value and we're approaching a policy in the manner of, hey, I want to be able to pay in this much money per year. Well, the main thing that we want to take care of then is that MEC limit to make sure, okay, based on the IRS limits, I want to make sure that that MEC limit is at my desired maximum payment, sometimes a little bit higher if I want to pay into it for a long period of time. That MEC limit has some rules after the first 7 years. It tends to vary a bit. Typically it goes down. Point being is we've got to set it up properly. This way you can use the policy how you want from a funding standpoint. And then once that cash value is there, beginning in the first year, you should have most of your payment available in cash value. Once it's there, then you have access to it to use for whatever you'd like. Hope this helps. Reach out with any other questions.
Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.